Thank you, Yuri, and good afternoon, everyone. Thank you, Yuri, for your introduction. So today's webinar is for those people who already knows basics about real estate and mortgages, and you're probably likely owning your own residence, and just start thinking about possibility to purchase some investment property for yourself. Start building that part of portfolio. So I'm not going to talk about basic terms today, but instead we'll focus on some important specifics related to inquiring and financing investment properties. So buying rental property can be a great way to invest for the long term and generate monthly income. Like any investment, knowing the pros and cons before making your decision to buy property and be clear on what your goals and risk appetite for owning rental property are. It's so important. So we'll be reviewing today some key questions and discussing some tips that we need to keep in mind as you contemplate making a purchase. Assess your current financial situation to see if buying investment property makes sense for you now. So here's a few questions to consider. Can you make a sizable purchase like real estate and still cover your existing financial obligations? And in many cases, it will put some financial weight on your finances. Is your credit history in a good standing? You're in a good standing. Do you have minimum down payment, which you would need to secure financing? Have you considered the closing costs into your expenses? Because that may be quite significant to close the deal. If any repairs needed to the property you're planning to buy before you can rent it, it's rentable. So do you have that money to pay those, to cover those repairs and costs to carry the mortgage until you're able to rent it? Because sometimes, the repair will take you a few months. And for that period of time, you need to cover the mortgage payments, property tax, utilities, all you need to cover, and you don't get any rent for that time. If you have a primary residence, could it be used as a potential financing source? So you probably know that if you have no mortgage or it's not a significant mortgage, you can refinance and borrow up to 80% of your current home value to help to get the down payment and cover the expenses for your investment property. So buying rental property can be a great way to invest for a long term and generate monthly income. So you can see 4 ways the people who investing in investment property can make money. So the first one and the obvious one is monthly cash flow. So the cash flow, basically, that's your rents, the income you get from the rental property minus all expenses you pay to cover owning that property and paying the mortgage. And in Toronto, it's not uncommon to see properties like that are just 50 or 100 cash flow positive each month. That's it. So don't think about thousands. And there are plenty of investors out there who brings the less in rent than their expenses. So their cash flow basically negative. So they have to put money into investment properties from their own pocket, from their own budget. Negative cash flow investors are betting on the benefits of appreciation, equity buildup, and improvements. So the second big thing, which lots of investors kind of hope for, is appreciation. And its amount increase in value over the time you own it. So real estate market in Toronto during the last few years has been hot. So 4 or 5% annual appreciation for condos and 10% plus annual appreciation for houses. So, but don't be naive and think that's always be the case. Like you saw in 2009, 2001, not to talk about 1991, 96. Um, those periods, it was either zero growth or even the prices went down, and sometimes significantly. So be prepared for that, and remember that investing in real estate, it's like investing in the stock market. Is the best. You view it through a long-term lens. So the next way to make money on the investment property is equity buildup. So every month, the portion of the mortgage is getting paid by your tenant, right? So the tenant gives you the rent and you cover all expenses. So you're building up equity in your property. So for example, like 600,000 mortgage at 3% of interest will have shrunk to 530, so it's 70,000 less by fifth year, and to 432,000 by the 10th year, and 320,000 by the 15th year. So it's basically you getting a 270 over 15 years just by paying down the mortgage and so on. So the difference between, so that's your money. And the fourth way to people make money on investment property, it's improvement. So depending on the type of the property you buy and how long you keep it, there may be opportunity to renovate or increase its value for different ways. So many house investors renovate or improve right away. For example, they may make a 2-unit house into 3-unit house, or they may upgrade the finishes to justify the higher rates. Other investors will choose to renovate right before selling. This is common in the condo market because it's run down after the tenants, so you want to make it looking better. But be careful with this because 50,000 condo renovation may not pay you back 50,000. It may pay you back just 20 or 30,000. So before doing this, so talk to your real estate agent. Is it worth it? As you identify potential properties and looking for them, here's some additional consideration to guide your search. So you need to decide who's going to be a legal owner of the property. Some people choose their own names or the team or group of people, and some people register the corporation and put that investment property on the corporate name. Second is what type of property you're going to purchase. So most first-time investment property purchase buyers tend to start with the condos or single-family homes. However, multiplex units are generally more likely to be cash flow positive, not the single unit properties. With property bigger is not always better as well, because it likely means more taxes, more space to maintain, more higher utility costs, and incremental rental income you're getting from that bigger property may not to cover the additional expenses you have to carry. So what's your ideal location? So to attract high quality tenants, look for a property close to schools, hospitals, public transportation, businesses, retails, and so forth. Focus on neighborhoods where demand for rental property is strong and expected to remain so for the immediate future. So, and look at how's the local rental and job market. The number of rental properties for sale in neighborhood can impact the price you'll pay. A healthy and growing job market will likely spur demand for housing and may result in rising rental income. A growing area with major improvements project planned, like mixed-use residential retail developments, subway stops, GO train, or health clinics, could make the location more attractive to potential renters. And does a purchase make sense? So always remember the investment property, that's a business, and any business has to be profitable, not taking money out of your pocket. They should put at least not to take money out of your pocket, but to put more money in your pocket or build a long-term equity in it. Definitely before moving on, so get financing pre-approved. Talk to experts. Talk to real estate. Does it make sense? Talk to the lawyer. So what's the best way to acquire that property? So the first thing I mentioned, who should own an investment property? So decision is to whether own on your property one of the personal formats or company formats depends on the strategy you have for your property portfolio. So if you buy, one or two properties, one unit as your current investment, and you're thinking, oh, yeah, I may sell it in the short or medium term. So definitely, it's more beneficial to buy on your own name. Yeah, definitely, you'll suffer the higher rates of income tax on the rental income, but you enjoy the lower rates on the mortgage and lower rates on capital gains when you sell it. So when, however, you have a strategy of building a larger portfolio of the property for the long term, or possibly thinking about passing the built portfolio to the future generation, like your kids or grandkids, the key is uh, or the retention of the rental income and or offsetting, let's say, profitable property against the negative cash flow property. So it's a good choice to register the corporation. So it stays inside of the corporation. Yeah, so definitely what's real estate. So in Canada, basically that's the land and buildings and air above the land and the ground below the land, which is on the land. But for purpose, as I mentioned at the beginning, the purpose of today's presentation will talking about residential properties purchased in order to rent them out. So we're talking about two types of investment properties. So what is residential? So what's the definition of residential? It's either an individual condominium residential unit or a building with one or four units. So it's between 1 to 4, where at least one half of the floor area of the building is utilized as one or more private residential dwellings. So which means, well, let's say you buy 2 units, and on the first floor it's a store or whatever shop, and the second is 1 or 2 units. So if the residential units 50 or more percent, that would be called residential property. So even though it has a commercial component in it. On the other hand, the commercial property is also called commercial real estate investment and income property. It's a buildings or land intended to generate the profit either from capital gain or rental income. So commercial property, what called commercial, includes office buildings, medical centers, hotels, malls, retail stores, multifamily housing buildings, farmland, warehouses, garages. So whatever is more than 4 units, that's a commercial property from the point of view of financial institution point of view. So, and you can get, buying the investment property, you can get 3 type of the mortgages. So residential, which is 1 to 4 units, but 1 unit is occupied by owner. And it will be a residential mortgage. The investment mortgage, if you buy 1 to 4 units, but it's non-owner occupied, and it should be owned by individual. So all 4 units, let's say 3 units, 2 units, occupied by tenants, so you don't live in it. And commercial mortgage, if it has more than 4 units, like 5, 6, or it's owned not by individuals, by corporation, organization, trust, whatever. So residential mortgage, as I mentioned, it's a 2 to 4 units owner occupied. So in this case, you can put down at least 5% if it's 2-unit property, or you have to put 10% down if it's 3, 4 unit property. So interest rate for that kind of mortgage would be the lowest, because basically on the books, for the financial books, it would go as a residential mortgage, and it's a more preferential um, way for financial institution to assess you. So residential mortgage, the best rate, it's easy qualify, because basically you qualify as for your primary residence. The second type of the mortgage is investment. As I mentioned, it's 1 to 4 units, non-owner occupied, but owned by individuals. So the minimum down payment must be 20%. Premium, so you pay a little bit higher interest in many cases, not necessarily, but in many cases there will be higher interest rate for that kind of mortgage, and your amortization is 25 years max. I didn't mention that on a residential mortgage, so you can have a 30-year amortization, and in some cases, some financial institutions, it could be 35-year amortization. So which makes, in many cases, easier to get the mortgage. And if it's investment mortgage, there would be additional requirements to qualify for the mortgage. So we'll talk about that later. And the third type of mortgage is commercial. So it's a property owned not by individuals like corporation or trust or whatever, or it's 5 or more units. So let's say, even though it's a single family house, which was turned into 5 unit property, even if it's owner occupied, because we had the cases, let's say the owner lives in the basement and has 4 units upstairs, that would be considered commercial, even though it's owner occupied. That's 5 or more units. So down payment depends again on the type of the property you're buying, but yeah, in most cases it has to be 20-25% down. So it's much higher interest rate. So usually for the commercial mortgage, it's like 1.5-2% higher interest rate, and usually it will require the personal guarantee from the owner of the corporation, because some people think, okay, so I put this property on the corporation, I have no liabilities, no way. So financial institution wants you to sign as a guarantor, so you will be responsible anyway. And definitely it's even more requirements to qualify for the mortgage compared to residential or investment mortgage. I mentioned that location is very important. So what is the ideal region you would like to buy investment property in? For some, proximity will continue to be the main factors, because you want the real estate you buy close to where you live, so you can, in case emergency you need to fix and you decide to do it on your own, so it's easy to travel there, and you can keep eyeing on the things as well. If it's owner occupied, it's definitely just next door, but if you buy investment property, you're not going to live in, so that you want to be close. But for some people, uh, they focus on the price tag. So we had a case, the gentleman, our member, wanted to buy property in the Kitchener-Waterloo or Hamilton. So he bought like 12 properties in Hamilton. Why? Because the price, now the prices went up, but 5-7 years ago, it was undervalued market. So he thought, okay, I can afford it because I don't have down payment, and it cannot cover the expenses. So the price tag was the main factor for him. So what's the best places? There are many great places to buy, and you always can find something anywhere. But we'll focus on some of them. Definitely, the GTA or Toronto, the Ontario capital, is the center of the action, so, which is why it's still very much on most people who wants to buy something, especially if you live in Toronto. While the metropolis is the priciest place to invest on this list, it can still be a great long-term investment. Toronto continues to draw businesses, immigrants. I know now it's pandemic and lots of people moving out, but it's going to be over, and Toronto definitely will stay as one of the hottest place in Canada. So it attracts lots of immigrant students each and every year. Last year, University of Toronto alone had 90,000 students, and almost a quarter of this, like 21,000, were international students. Yeah, not this year though. Across Canada, we're seeing a huge increase in international students. It's 18% in 2019. With University of Toronto consistently making the list of the best universities in the world, the city can expect to continue to see more and more students moving into the heart of the city. Um, so Toronto has lots of universities: Cat University, Ryerson University, York University, University of Guelph, Humber, Centennial College, George Brown, Humber College, Seneca College, and so forth. Many of the students coming to Canada are staying after the graduation, choosing to work and live in GTA. Immigration as a whole is a huge asset for the city. So Toronto is continuing to see a large percentage of Canada immigrants landing and settling in the city for work. These are people who look to rent upon arrival. And you can see the prices. Definitely, single detached house is quite expensive. Townhouse is expensive too. I remember like 10 years you can buy a townhouse for 250, 300, but now it's the average price is 650. And apartments, it's almost 600. Unbelievable. Durham region. So Durham region is a home for Pickering, Whitby, Ajax, and Oshawa. This region east of Toronto is building up as more people from the city are choosing to move east for suburban style. And as mentioned with pandemic, lots of people now thinking, oh, if I can work from home, so why would I, rent in downtown Toronto? So I can live outside with the bigger housing and fresh air, and just go to Toronto once a week. So Go Lakeshore East Line continues to expand with better services for commuters heading into the city. The 401, 407 both run through the region, making it convenient location as well if you drive a car. So as Toronto continues build up, its natural building up in these towns and seeing positive growth from migrants and new businesses looking for more affordable real estate near the city. So you can see the prices are half of you would see in Toronto, right? The Halton Hills as well. So it's a northwest end of GTA. This growing suburb has doubled since formed in 1976 when Georgetown and Acton amalgamated. Its proximity to Toronto, with regular GO train access and small town charm, has made it popular for families. With a population 61,000 in 2016, and it's growing. So Halton Hills is still rather small compared to neighboring cities. However, it's showing good signs that it's ready for growing population as more and more people look to call Halton Hills home. One trade would like to see that Halton Hills as a whole is almost non-existent vacancy rate. So there is no vacancy there in the recent years. So demand is very, very strong. Just few options to find the rent. Another positive note, the list is active development and plant infrastructure project happening this year and next year. New townhouse subdivisions, condominiums, office buildings, places of worship. In other words, places for people to live, work, and build the community. These are all good signs for growth and definitely to buy property in. Price is a little bit higher than East, but it's a nice place to live. East Hamilton. I mentioned before our members built the whole portfolio in Hamilton. He started 5-7 years ago, but now it's still, as you can see, the prices are pretty low compared to Toronto or around Toronto. So for years, investors have been looking at the West End Hamilton for its proximity to university and hospitals. The down core had its up and downs, but has been attractive for its growing food and art scene. And Hamilton Mountain has been a popular option for families. Now, east of Hamilton is finally getting the recognition it deserves. So the East End is larger residential, making it popular for starter homes, and is a diverse immigration hub. With the resurgence of Hamilton's West End and core, more families are moving east for larger yards, more parks, walking trails, and affordable homes. Like the downtown core, East Hamilton is seeing new life moving in. So in 2019, Tim Hortons Fields is home for the Forge FC, part of the Canadian Premier League. So new shops, restaurants are moving. Well, the pandemic is not, but again, pandemic will be over. So you can see lots of stuff. The Go Station, they're building Go Stations, Confederation, Go Bus services, new Go Train services now scheduled to be up and running to 2021, making now and good times to invest in this area. And you can see the prices almost 2.5 times less than in Toronto. Um, Guelph and Kitchener-Waterloo. So Guelph actually was ranked #1 on the Bank of Montreal's list of best cities in Canada for new work opportunities. Unemployment is low and there are jobs to be had in this former farm town. Many schools are under renovation. The University of Guelph is finishing up an expansion of its health and veterinary science department. Stormwater system are being repaired, improvements are being made to the snow disposal facilities. These unseen improvements can go unappreciated and unnoticed, but they're important for keeping Guelph a top city to live and work. So near Kitchener-Waterloo ranked #4 on the BMO's list, which makes sense with the growing tech companies, universities, and healthcare all booming in the region. With the Kitchener Go expansion, more people will bound to moving into this area. And you can see the average price is half of the Toronto's. London, we have a branch in London too. London has one of the lowest vacancy rates of any Canadian city. It's also home for the Western University, Funchal College, and several hospitals, which are among the city's top 10 employers. London currently has 182 infrastructure projects in the planning and under construction phase. With big things are happening in the city and it's ready to grow and expand in its coming years. Schools, roads, housing, sewer, and water system and transit are all seeing upgrades, which will help the city handle a growing population. And you can see the prices, yeah, very, very attractive. Windsor, it's a historically been cheap city at the bottom of Canada, right on the Detroit border. So now the city is seeing major improvements as well, with the large infrastructure project happening throughout the city. House prices are on the rise, businesses are moving in. Yeah, pandemic a little bit slowed down. Unemployment was down, and the population was up. There are all great signs for looking to invest. In fact, the population of Windsor is slow growing faster than it has in 2 decades. Employment is the highest. It has the highest rate in 18 years. So, and vacancy rates are down to 2.6%. These are great signs for the city and investors. So you may think you want to invest, and it's 4 times prices 4 times lower than in Toronto as well. So Niagara region is one of the Canada's largest tourist destinations, home to Niagara Falls and Canada's largest wine region. People continue to flock to this stretch of Lake Ontario's southern shore, but Niagara is no longer just a place to visit. More and more people are calling this region home. Jump in your car and take a drive down to QW. It won't take you long to see the developments lining the lakeshore. It's a trend that continues into Niagara's small town and larger cities like St. Catharines and Niagara Falls. And we have a branch at St. Catharines as well. So Niagara has a rental shortage, and it is only getting worse. The vacancy rates are very low, and there are not enough affordable houses for many people in the region. So Niagara is also getting a huge Metrolinx expansion over the next several years. GO services have already started running daily and will become more frequent in the coming years. So, and you can see the prices as pretty attractive as well. So Sudbury, creative Sudbury touts one of the most affordable real estate markets in all of Canada, thanks to factors such as increased livability, expanding job diversity, and affordable cost of living. Sudbury has become a price spot to settle for students, families, and newcomers to Canada. Sudbury also has a low vacancy rate, 2.1%, which translates into just it's 21 out of thousands of apartments being available to rent. And the low rate vacancy means increased demand, and it means increased rental prices. Many prospective tenants and healthy return on investment as a landlord. This bodes well to those looking to invest in Sudbury's fast-growing real estate market and expand supply in multifamily segments. So you may want to look at this and look at the price. It's just amazing. Okay, so you made a decision who's going to be a legal owner. So you look at the different areas. So you decided to invest in the region you want to invest. So now you need to get the financing so to see what you can afford. So as you would qualify for the residential mortgage, there are some additions when you qualify for investment mortgage. So the down payment would be first on the list, and depending on the property, it's 5, 10, 20, 25%. So 5 for owner occupied, 1, 2 unit property, you can just put 5% down. If you buying owner occupied 3, 4 units, it should be 10% down. If it's investment property like non-owner occupied, you can go as low as 20% down. And if it's commercial for the corporation, the minimum would be 25% or even 35%. It depending on like what kind of property. That's commercial unit in this or not. So definitely it's important to your personal income. So your ratios are good in line. So you need to get all rental property financials. So the vacancy, what's the rental income? You probably want to ask the seller about rent roll for the last 2-3 years. What expenses to see the copy of the bills, the property tax bill, utilities bills, to calculate that ratio, which we'll discuss a bit later. So your credit history has to be nice, good enough, especially if the mortgage will be insurable. So when you put less than 20% down, because there is minimum thresholds for the credit scores and other considerations. So definitely your relationship financial institution, existing credit load with financial institution, and so forth. Down payment and closing expenses. As I mentioned, lots of people may remember about down payment, but they forget about closing expenses. So what you can use for down payment. So you can use definitely your savings, investments you have. Also, many people use for down payment and closing expenses equity they have in their residential property or in other properties they have by refinancing existing mortgages, or if you don't have any mortgage on your house, you can get one up to 80%. Or if you don't want to touch your existing mortgage, let's say it has a very nice rate, or you would pay the higher penalty on breaking it, so you may arrange the second mortgage. Or if you're thinking about buying something and you need to repair or convert it to 2-unit into 3 or 4-unit house, so that will take some time and money, and you don't know exactly you need, so you probably want to rent home equity line of credit. And definitely it's other available financial sources which you would like to discuss with your lender, with the expert. So whatever branch is close to you, just go to see the lender, talk to them, give the all information, and will help you to plan what's the best way to prepare for down payment and closing expenses. And yeah, don't forget about closing expenses. There are many, and you can see on the screen. So it's quite a lot of expenses. You can see some examples in different regions of the province of Ontario. So the biggest one is definitely land transfer tax for the province of Ontario. If you buy in Toronto, so there will be the same municipal land transfer tax, real estate fees, lawyers' fees, title insurance, fire insurance, status certificate. If you buy condominium, you would have to cover the appraisal fee. If yeah, in many cases you need to do the house technical inspection, cover this, and in some cases you need to do survey, and it's quite costly. Yeah, I was talking about that the investment property has to be a business, so you have to run it as a business, and it has to bring it should be positive cash flow. So I'll give you on the screen. You can see the real life example. I took the names off and the address of the property, but this Ukraine Credit Union member has two properties with us, and you can see two columns. Property one, it's a single family house they rent out. It's an investment property. And the second is a townhouse. It's a condominium townhouse. So you can see the rents. It's all annual. So we calculate all annual. Any financial institution will take allowance for vacancy, because sometimes it happens if one tenant goes, so you need to find another tenant. Sometimes it takes a month, sometimes it's right away. But again, it's 5%. That's what we put allowance on. Maintenance factor, yeah. Sometimes you can buy the brand new house, so it almost no maintenance. But sometimes it takes a lot to fix the older house. But again, the standard allowance is 5%. So we take 5% for repair, 5% for vacancy allowance. So you can see gross income on the both properties, so minus 5%, and it could be other income. So some houses can laundromats, so you have to, pay for it. Some additional for the garbage, for the parking, whatever it may be, whatever you can, extract from the property. But in this case, they don't have any income except a laundromat for 600 for the house. Expenses, definitely municipal taxes, insurance. In this particular case, the heating and electricity, hydro, are covered by tenants. So if you have separate meters for all tenants, and you put in the agreement that they should cover whatever they use, so then you have no expenses. The water, repair, maintenance, 5%, I already mentioned. And management fee, let's say if the property, in this case, the property was quite away from our member, so he pays like $100 to the guy in case they need to come, to change the bulb or fix the sink or whatever. So that's the fee. And in condo fees, you can see the maintenance fee and the condo townhouse. So, and the total operating expenses, 11 and 8,000, and difference between income, that total income and total operating expenses. You can see it's green, but then it comes to all mortgage payments, principal and interest, P&I. And see those properties, one property comes in a positive cash flow, $16,500, but the townhouse comes with the loss for almost $8,000. And the ratio I mentioned, the debt service coverage ratio, which every financial institution have to calculate. And according to our policy, it has to be more than 1.1. So in case of the property, the first property is very well positive 1.8, and the second property runs with the losses. But overall, the portfolio brings the 122, which is pretty safe and great. So that's important that you have the positive cash flow, is in case something happens, so you don't have to take money out of your pocket. And as any when you get any type of credit from financial institution will calculate the service ratios, gross debt service ratio and total debt service ratio, which you probably know about that already. But the mortgage payment, all expenses, the shelter expenses, we call it, you have to cover to maintain this property, divided by into gross annual personal income. And in some cases, you may include the 100% of rental income, but some financial institution will take only 80% of rental income into consideration. And if you need to insure it, so the CMHC or Genworth, they will consider only 50% of the rental income included into that annual income. As you can see in the brackets, 2 units or over 80% loan to value. So if you come to Ukraine Credit Union, we will consider 100% of the rental income if it's 2 units or less. Total debt service ratio formula, it's all mandatory expenses you have during the month. It's a shelter expense plus whatever you may have, car loan or lease, the credit card debts, line of credits, and again, it's into your annual personal income, and we will consider the 100% rental income, and other financial will consider only 80 or 50% even. And if it's more complicated case, you can see if you need to insure it and you put 5 or less than 20% down, then it's different scenarios. If it's 2 units, that's one scenario. If it's 3, 4 units, another scenario. If it's owner occupied, they will look at this and calculate separately. It's not my intention to discuss this today. So if you need to calculate and see your particular situation, please come and see Ukraine Credit Union lender, the branch closest to you, so they can help you to what appropriate formula we have to calculate and qualify you for. And as last on the list was your credit history. So it's based whatever you do, and because all financial institutions, almost all financial institutions, will report to credit agencies, and any lenders, they have agreements, so we can pull out your credit report and see how you discipline you, how responsible you with your credit, so we can predict if you will be the same with this credit. So your credit score is a key, especially if it's insured mortgage, then it's minimum threshold that you have to pass. So if you have worse credit than a threshold, you will be definitely declined from getting that mortgage. Okay, I guess that's pretty much it I was about to tell you today. If you have any questions, please ask them in the chat, and for more information or you want to discuss it, details, please see me or any of Ukraine Credit Union lenders.
Thank you very much, Vlad. We have time for one question, I see, and I see some people have thanked you for the presentation in the chat. But the one question is the sorry, I've lost my train of thought here. Is the your you know what? I've lost my train of thought here, so don't worry about it. We're a little bit out of time though, because it is now 1:55. So if nobody has any more questions to type in, then thank you very much, Vlad, and we will see you in the next webinar coming up in a couple of weeks. Thank you very much. Bye.
Thank you.